if we turn around and sell it in 2 years for twice what we paid for it, well, then that's great. If not, and we have to fight through a down market and we fight our way back through, I think what people know that have been in the business a long time is that, it just about always bounces back. I can't think of a piece of real estate that I've owned directly that I've ever sold that I wish I hadn't. I wish I'd kept everything I ever bought, right? Because, it would be great now, but you can't do that. It doesn't work that way.
Hey, this is Bo Barron, owner and managing director of Barron Commercial Group, and he's zoning out right now, but that's Timmy Barron, ADHD, actor and comedian.
Oh, are we doing that?
I'm already done with this. Hey, let's start over. Hey, this is Bo Barron, owner and managing director of Barron Commercial Group,
And then this is Timmy Barron, owner, and I don't own much. I'm an actor. I'm learning about commercial real estate. He's teaching me about commercial real estate.
What's the name of our podcast here?
Commercially Speaking.
All right, let's do it. What a train wreck. We have Dr. Jeff Engelstad, CCIM, here with us today, which I'm really excited about. He's a CCIM instructor with me. Are you Dr. Jeff Engelstad?
I am. I have a PhD, which stands for piled higher and deeper.
Yeah.
Bo, I was in a PhD program before I knew what PhD stood for. Seriously. I'm the first generation to go to college. My mom grew up on a farm in Missouri. My dad grew up on a farm in South Dakota. Nobody ever went to college, right? I had the best upbringing as a kid. I'd come home with B's and C's, and my dad would say, "Oh, it's good. You're average," kind of thing. Then, I decided I'd go to college and then go to more college and go to more college because no one else had ever done it. So I made up for lost time.
Nice. Timmy, we've had some episodes where we've talked about syndications. I gave you the pitch deck episode. Jeff has done many of these, and he's been the guy on the general partner side, kind of the sponsor side, and more recently, as we've talked over the last couple of weeks, he's been more on the limited partner side, where he's more of the investor than the guy who's running the deal. And so what he thought we'd talk about today are some of the differences, the pros and cons, the different profiles of somebody who might fit more as a GP or a general partner versus a limited partner, and kind of how he's transitioned from one to another. But I'd love to hear a little bit about that backstory.
I've been in commercial real estate since 1979. 1979, I turned 18, and I had to register for selective service and get a real estate license. That's what I did when I turned 18. I actually started selling residential real estate first, and I was 18, but I looked like I was about 12. And so it was really fun. And if you'll remember, around 1980, 1981, you know what interest rates were?
Well, our dad has talked a lot about that, like 16, 17, 18%.
Oh, gosh, they were in the 20s sometimes. And we used to sit around the office saying, if interest would just go down to 12%, that's only 1% a month, we could do a lot of business, kind of thing. And then it was about 1980 that I was working in a real estate office, and it was a very old-fashioned kind of a deal where we had a floor person, the broker of the day kind of thing. Yeah. And so one of the guys had to sit on the floor while everyone else had lunch. Well, that was always me because all the other guys were older, and they said, "Hey, you probably have a tuna sandwich in a bag. Why don't you cover the floor for us while we go out and eat?" I did that, day in, day out, day in, day out. One day, some guy comes waltzing into the office. I'm the only one there. And he starts looking at this map, and we start talking to him and things like that. And I thought, man, I hope those guys get back from lunch soon because I think this guy's going to buy a site in this industrial park. Turns out he bought the entire industrial park. Oh. He was representing the Gimbel family out of Chicago. And so I'm 18 years old, and I just made a big, giant sale in commercial real estate. And I thought, this is the best business ever. You just don't take a standard lunch. You'll be okay.
Yeah.
Oh, wow.
And I never sold another house after that. And I was probably 6 months in the business at that point. And then I took my first CCIM class. And I thought that was the best thing ever. And this is back in the day when you could put together partnerships and your partners could write off as much as they invested. And I could go to you, Bo. I could say, look, Bo, if you put $50,000 into this real estate investment, you'll write off $50,000 in taxes in your first year. And so it's like we're talking about, did the economics have to make sense? No, sometimes they didn't have to make sense at all. And people were putting together deals that, in my opinion, didn't make any economic sense. I started putting together deals that were truly general partnerships. And in a general partnership, each partner is generally liable for everything. And so that means that nobody has any protections or anything like that. And I would be the managing general partner, meaning I was going to take care of everything, but those other partners were also on the hook for everything.
So like joint and several on the hook?
If we're all general partners, we're all liable for everything. Somebody slips and falls and breaks their head, we're liable for it. But you see, we can cover those liabilities. We can mitigate those with insurance. The one thing that we can't insure against is defaulting on the loan. Well, if we're a general partnership and we've all signed on the loan, then we're all liable. And that's where that joint and several liability comes in. And what the bank's going to do in that case, if there's a default, they're going to go after the deepest pockets. We've got 6 guys in this investment, and we're having trouble and we're in default, and the bank's going to come after you, and they're going to sue you for the entire mortgage amount, $8 million, whatever it is. They're just suing Bo for it. And then he's like, well, wait a minute. What about all these other partners? And they'll say, well, you go ahead and sue them if you want. Go ahead and sue your friends. And that's exactly how joint and several liability works. If you sign a note for $1 million together with 5 other people, you're all signing, promising that $1 million.
Mm-hmm.
And so in a limited partnership, you have to have at least one general partner. So someone's got to be the general partner. Somebody's got to shoulder the risk. There was a time that you could form a corporation, and the corporation could be the general partner in a limited partnership.
Really?
And therefore, you had no liability at all. Nobody had any liability except for that corporation, but that corporation had, their assets were like a mouse. They didn't have anything. So that worked pretty well. And then the IRS shut that down really quickly.
Whoa.
And then in a limited partnership, the limited partners were limited only to the amount of money that they put in. So you couldn't come after them for any more or any other thing like that. But since the general partner was taking the liability, the general partner also always took a very generous proportion for themselves. So what I thought way back in the day was that I will go with people that I know and that trust me, and I'll do general partnerships. We're all going to be general partners. And we're doing deals that were small enough to where we all had to sign on the loan anyway. And the story was, and it always comes down to a story in the investment world. Bo, you know that, being a commercial real estate broker. I mean, there's always, it's what kind of story can we tell? And my story was this: we're all going to go in equal footing on this deal. And we're all going to be general partners. And we're all going to be liable for the debt. And so we're going to go in with a lot of equity. And then I'm only going to take a preferred interest after everyone else has gotten their money back and is happy. Most of the stuff that I did early on was really a subordinated interest, in the sale. And if we didn't sell, if we didn't meet the pro forma that we thought we were going to meet, I didn't get anything. I didn't get anything extra.
Can we break that down just a little bit?
I actually just wrote down subordinated interest.
Yeah.
Talk
about what that is a little bit before Timmy's brain explodes. Yep.
Thanks, Bob.
It means that I don't get mine until you've gotten yours. Okay. And I think if you're going to be my partner, Timmy, I want you to invest in this real estate deal with me. And once you get all your money back plus a return, then I get 10% after that as a bonus. So I get my bonus, but my bonus is subordinate to your getting your money back and your negotiated return, whatever that might be.
Gotcha. Because I was thinking, because Bo, you do limited partnerships, right?
I do. Yep.
As the general partner, you are making the most amount of profit if the sell makes everything profitable. You're making the most because you're the general partner. But what you're saying, Jeff, is if everybody's a general partner, it's equal, except if you're the one that's putting it together to make me, the investor, feel better, you're like, hey, you get yours first before I take mine.
Today, chances are if you buy something, you're going to put it together in a in an LLC or something like that. Probably the most simple form of of group investment that exists today. 3 of us could set up an LLC yet this afternoon.
Let's do it.
And and so when we talk about GP and LP splits, it's really not as specific as a limited partner, general partner arrangement all the time as it is who's the promoter and who's the investor. The promoter is the general partner. That's the one who found the deal and is putting it together and just needs the money. And then the investor is, makes a lot of money doing something else, has no earthly idea what they would do in real estate, but they're investing in this project because, I'm investing with Bo because I believe in what Bo does and has done and all that other sort of stuff.
Could you take what we've talked about and maybe tell an early deal story where you went in with, it was a general partnership deal, you and some partners, some other investors? Just give us a feel in the context of a story.
Well, I'll give you one that I always recall. I was the managing, I was the GP, and I was getting up in everybody else's, equity and that sort of stuff. And it was on an office building, fairly good sized office building. And I was in my 20s, and I was frankly pretty impressed with myself because I was getting these guys that were older than me and smarter than me and whatever to invest with me. And I'm thinking, wow, maybe I really know what I'm doing. And so we gathered enough equity to buy the building. My story was, this building was about 40% vacant, and I can fill it, and we're going to turn this thing into a good investment. And so we buy it, and then I start executing the plan, and I get a tenant teed up and all this kind of stuff, but we need tenant improvements. And I didn't gather any extra money for that. I made no provision for that, nothing at all. And now this is like 2 months after I put the deal together and thought I was like, big man on campus kind of thing. I got to go back to my partners and say, tail between my legs. And it's like, guys, I kind of miscalculated. As the old saw on CCIM is means can't close, I miscalculated.
Oh.
If I'd had enough money myself, I'd have lent the partnership money, which you always figure out you can do, right? Because then I wouldn't have had to go through the embarrassment. But anyway, the guys, they came up with the extra money. In fact, I think some of them were embarrassed because they're like, well, I probably should have known that too. But that's always my, cautionary tale is when you're gathering money to buy something, get a little more than you need because you never know what's going to come up, and make sure you understand what it is that you need.
What percentage would you recommend people have extra?
If we're buying a net leased industrial building with one tenant, then we don't need a lot of reserve. But if we're buying a retail strip center where it all needs fit out, you need a lot of additional money. So yeah, it kind of goes deal by deal.
Yeah.
The last deal we did was a retail strip center. We had one vacancy when we bought it, but the big opportunity there was the average rents were well below market. And so the story was, we're going to buy it, we're going to re-tenant some of it, we're going to increase rents or renewals, and we're going to be able to get to market. It's going to be worth a lot more.
Yeah.
And we had some tenants basically come to us and say, look, we'd like to leave. We're going to, I had a mom and pop that said, look, we're going to move to North Carolina. We'll continue to pay until you can replace us, but could you try to replace us? And I was like, great, because they had one of the lower rents, and they were going to continue to play and just not go dark on me. It's a great situation. Way faster than we expected. We were able to re-tenant and raise some rents, and we were way ahead of the game, but that took more money faster than I expected. And I got to the point where like, man, I wish I would have raised double the amount we had in reserves. Every deal I've ever done, I wished I would have raised more and had more in reserves.
But it's really hard to do because raising that money is difficult. And you're always thinking, if I have to raise another 100,000, well, that's on a small deal, whatever. That's another partner. And it's hard enough to get these partners and things like that. So yeah, I think that's probably a pretty common concern. And so, for years, I was the one putting the deal together and benefiting from the promote structure or the subordinated interest and all that sort of stuff. And then here lately, I find myself on the other side of the ledger. And so now I am the limited partner, not the general partner. And so I'm just the investor in the deal. So I want to look at what is the general partner taking out of the deal and when. Like say Bo's going to be the general partner and I'm going to be the limited partner. And let's say I put in 90% of the equity and Bo puts in 10, but then he takes 20% of the deal. So his 10% bought 20%, bought twice as much. Well, that means my 90% didn't buy quite 90%, only bought 80%. Right. And so I look at that. Does that make sense? And then how many other fees is he charging me? Is he charging me an assets under management fee? Is he charging me a construction management fee when we do tenant fit out? Is he charging me a point when he does any kind of financing? Is he charging me, $1,000 every time he sneezes on a Tuesday? All kinds of stuff. You'd be surprised at some of the fees that people will put into these deals.
Yeah.
Because a lot of times the general partner is motivated to make money now, whereas the limited partner is most of the time not concerned about that. What they're concerned about is stability going forward. And so it puts them in an interesting position. The other thing that I'll look at is how is the general partner going to get paid? Because a lot of these deal structures are like this. The GP is going to get paid on exit. That's when they're going to make their big hit. Now, maybe it's not in my best interest to sell it at the end of 4 years or 2 years or whatever. Let's say we had a pro forma, kind of a typical deal. This is an interesting point. The very typical deal that gets pitched to a limited partner is a 5-year holding period showing about a 15% internal rate of return. So if you invest your money, you'll get about a 15% internal rate of return over a 5-year holding period. And that's, it's just almost like somebody told them they all have to write it that way. But here's the interesting thing, Timmy, is you double your money every 5 years at 15%. It's a rule of thumb. It's not exactly right, but that's a good rule of thumb. So wouldn't you like to double your money every 5 years?
Yeah.
Yeah, think about it. Think about it. If you started with $1 million and you doubled your money every 5 years, how much money would you have in 25 years?
We generally don't ask Timmy math questions.
I can do.
You can use your fingers and toes for this.
Okay, cool. Let me take my shoes off. 5. So 5 years, we start with $1 million. It doubles every year. So $1 million.
And it doubles every 5 years.
It doubles every 5 years. So in 25 years, is what you asked. Okay, I got it. Ready? 16 million.
$16 million. Look at that. Yeah, your $1 million grew to $2 million in 5 years, and then grew to $4 million in 10 years, and grew to $8 million in 15 years, and grew to $16 million in, I think, 20 years, and in 25 years, it would have grown to $32 million.
Ooh.
I think we only held it for 20 million. So, I'm sorry, for 20 years. But anyway, that seems to be a really wonderful standard of investment return, is that 15%. Now, are you going to get 15% all the time? No. Have you gotten more than 15% on some investments? Yes. If the GP is only going to earn their promote when we sell, and that's the way, again, going way back, that's the way I put my deals together, right? Then I think that puts me at odds with them a little bit, because I might think that, we don't need to sell this thing because we're making great money and all this kind of stuff. And I'm in it for the very long, my view is long term, but they're like, no, we need to sell this thing because if we sell it, I get a big old payday and then I can go do another deal. And so it puts us in a little bit of a conflict situation.
Right.
It's like my friend, very good friend that I've known forever. We went to college together and he's from Osaka, Japan, Japanese guy. And he told me, I don't think it's true, but he told me the term joint venture, loosely translated into the Japanese, means same bed but different dream. Sometimes that's where we are with the general partner and the limited partner.
How would you structure a deal so that the GP and the LP's interests are more aligned?
What I look for is the GP who's not going to go running for the exits if the market goes south. Who has the idea that, you know what, we're going to hold this thing and we're not going to try to just lever it up and lever it up and lever it up. That's the one that the deals that I'll pass on is where the plan is we're going to buy this and then we're going to hold it for a couple of years and then we're going to refinance it and try and pull most of our money out. I would sacrifice a couple hundred basis points of return for stability. I think the world is full of investors that are like, you know what, if 15%'s kind of going, I would do 12. If I felt like we really had something that, you know, we're going to manage this thing down to less than 60% debt. Because one thing a long career in real estate has taught me is that debt is not necessarily your friend.
Okay, I got a question for you. Because I know Bo, like his investors, he's like, look, I'm taking this. What I say goes. If you can do that deal and you feel comfortable with that, great.
I say it a little bit nicer than that.
Well, not when you're talking to me.
Well, I've told this story before. The second syndication that I tried, we were buying 48-unit apartment complex, and the first guy I pitched it to took the whole deal.
Yeah.
And I was like, great. And it didn't turn out great because the way the deal was structured is you have no authority and you have no responsibility. It's all on me. Okay, the good and the bad, it's all on me. My job is to make you money. But since he put all the money in, he just didn't see it that way. And so it created a conflict between us that didn't end real great. The next deal I did, I had somebody take 30% of the deal. And I was a little bit uncomfortable with that one. But that one's worked out. There were six, 7 other guys in that deal. And
here's what happens is you go into partnership, and it doesn't matter whether it's a real estate partnership or a marriage partnership. You know, I mean, you go into partnership with a set of expectations, and then things change over time. The way you went into this deal is not exactly the way you feel now, you know, and things like that. So that's always a tough one. I think the other one is I really appreciate GPs that communicate well. You find that the GPs are really good at communication when things are going better than they planned, because it gives them the opportunity to say, look what a stud I am. You know, look what I did here. But when things go bad, what I learned the hard way is that communication is much more important, because you got to bring them along with you. Because what happens is if you delay the communication, now all of a sudden you're going to have a little partnership meeting and tell them we're about 60 days from default. And it's the first they've ever heard of anything, right? And, you know, that's just doesn't do much for them. My 62-year-old self would go back and tell my 29-year-old self a lot of things, like be straight with people. They really like that. It's actually better to be upfront. You know, that's what I learned from that experience, and I think many other people who have done this have learned that the hard way.
Yeah, that's one thing I really respected about Bo when Bo was pitching me in that one episode, was how you are clearly laying out the expectations and saying things that, you know, imagining myself saying them would be uncomfortable. That would make me a horrible GP, because I'd be like, you know, something happened, you all can take some of my share or my like go, yeah, you know, just that people pleasing part of me that I'm still trying to tame. But Jeff, when you are going into or to meet with somebody who wants to bring you in on a deal as a limited partner, do you find it difficult to kind of take the back seat and let them drive?
That's actually a good question, but I don't want the hassle. Otherwise, it'd be the GP. I want to be the limited partner. I want to put the money in, and I like it when they talk to me and call me. And I think a lot of times they do, and we'll have a conversation on the phone. They probably do this with all their LPs or whatever, and you know, want to get my advice on something or this or that, because of course that makes us feel good.
I actually had one of my clients as their broker. I'm helping them put a deal together right now, and they're asking me to get in on it with them, and it would probably be a GP type partnership where we'd all be in it together. And I like the deal, but I don't think I'd be a good partner for them, because I think I would want control, and I wouldn't want to ask permission or have a committee meeting every time we needed to make a decision. And maybe I'll feel differently when I'm, you know, older and later. Right now, I want the hassle. You know,
Yeah.
But
Yeah, I don't know, Bo. I mean, it's like diarrhea. That runs in the genes, man.
here,
We do not want to ask people to or wait for a committee of people to.
we are our father's sons.
At some point, it's actually really freeing to let that go. It's like, you know what? I don't worry about that deal. I'm in a deal up in Duluth, Minnesota. I'm not even sure I can find Duluth, Minnesota. But I really like the guys that are doing it, and I really like what we're doing up there and all that kind of stuff. And I don't spend 1 minute worrying about it. I don't know that I would have been in a position to mentally to do this 20 years ago, but now it's perfect.
Yeah. Yeah.
Great.
Bo, you'll get there.
Yeah, you'll
Maybe.
get there. But what I'm thinking is that you guys that are putting the deals together as GPs, looking at guys like me to be the LP, you got to get in our skin a little bit. You got to say, okay, what makes him tick? Oh, those guys are not looking for immediate cash flow. They don't care about getting quarterly distributions, or whatever. And that's that cash on cash rate of return is probably not a big deal for them. They're not living on the money, right? They are looking for an investment that's got some staying power and that's, going to be good long term. If we turn around and sell it in 2 years for twice what we paid for it, well, then that's great. If not, and we have to fight through a down market and we fight our way back through, I think what people know that have been in the business a long time is that, it just about always bounces back. I can't think of a piece of real estate that I've owned directly that I've ever sold that I wish I hadn't. I wish I'd kept everything I ever bought, right? Because, it would be great now, but you can't do that. Then, it doesn't work that way.
Yep. Well, let's do the quiz. All right, pop quiz. What's the difference between a GP and an LP?
You've got G for general partner. The other one's L for limited partner, right? That's a difference, the G and the L. But typically, the general partner is the one that's running the deal. They're the master of the decisions, and the limited partner, to my understanding, is oftentimes just the investor.
Okay, I would say you're basically right there. Let me ask a follow-up question to that. What is limited about the limited partner?
The liability.
And the limited partner is at risk up to the amount of money they put in the deal.
Yes.
Yep. Okay.
Yeah. All right, cool.
Jeff, would you add anything to that?
If we all go together as any kind of group, general partnership, limited partnership, LLC, whatever, and we go together, three of us, and we buy a piece of real estate, what's our biggest risk?
Debt.
Yeah. Our biggest risk is not that the place is going to get struck by lightning, because we can insure against that. Our biggest risk is we won't be able to pay the loan. We're all going to be liable unless we can get non-recourse financing. So there's another vocabulary word for you. Non-recourse financing is your friend. Guess when you can get non-recourse financing?
Every 3 months.
You will probably
Strong enough to not need it.
Yeah, you will probably get non-recourse financing if the loan amount is so huge that you could never pay it back.
And Timmy, if it's a really big deal, where might we go to get that kind of financing?
CMBS loan.
Yes.
Well, I need one more question.
What does LLC stand for?
Limited Liability Corporation.
Okay, limited liability corporation, limited liability company, whatever.
Company. Okay. Yeah.
Where did LLCs come from? What state did they come from? When you think of great legal thought in real estate, what state do you think of?
Oh, no. Massachusetts.
LLCs actually started in Wyoming in 1980.
The year after you got into real estate.
Yeah, there you go.
Yeah.
And I was 3.
I was just swimming around.
Jeff, thanks so much. for coming on the show and for giving us your time. I'm looking forward to seeing you in a couple days in Chicago.
Yeah, we'll see you in Chicago. I have no idea what we're going to do. There's no...
Me neither.
I mean, you never know what's going to happen there.
Thanks a lot.
We'll see you
Thanks
later.
so much.
Thanks so much.
Thank you. Bye.
Can you imagine having him as a professor?
Mm.
That guy, you go out and have a drink with him, like dinner, whatever, like he's going to have you rolling. He's just a lot of fun. So I'm really glad we were able to have him on the show.
All right. Well, I love you, brother.
Love you too, man. Great to see you.
Bye.
See you guys. Bye, Alice.
Bye.
Are we all waiting for each other to hang up first?
Well,
I didn't know if I needed to wait for this. It says 99% up.
Oh, gotcha. You can hit
hit
the
leave.
leave button. Yep.
Mhm.
You get the leave button and just leave that window open. See ya.
Yeah, just like that.